Hi, this is Andy Hoffman, Media Director for Miles Franklin Precious Metals in our 25th year in business. It's midday, Thursday, May 22nd, and today's audio blog is titled Cluelessness on Parade, which I'm guessing you could figure is about the Federal Reserve as well as its cronies at the other Western central banks, not to mention the Eastern ones as well. Anyhow, this week's manipulation train is running hotter and faster than at any time in global history. And frankly, I'm not exaggerating here, in the least. With the exception of crude oil, whose periodic, mysterious plunges consistently are retraced by relentless global buying, the US led central planners have their hands in utterly every market imaginable. Consequently, the divergence between real economic activity and the recovery purported by relentless propaganda and market manipulation has reached epic levels. To wit, an article I just read depicting the only sector of the U.S. housing market experiencing higher prices is the $750,000 price level and above, incorporating a minuscule 4% of the total. Throw in the fact that the entirety of this increase has been fueled by free Federal Reserve funding to Wall Street, and you can see just how weak the broad housing market actually is. Care of the Fed-funded, Wall Street-engendered buy-to-rent boom not only is housing affordability near all-time lows, along with household formation and home ownership percentages, but rental prices are at all-time highs. Thus, with real inflation near record highs, median household income at 17-year lows, labor participation at 35-year lows, including an all-time low for the key 25 to 29-year-old segment, household savings averaging just $3,000, and the national savings rate at multi-decade lows, it's difficult to see why anyone expects housing to rise further. Not to mention, interest rates have not only been pushed by the Fed to an all-time lows amidst an environment of surging inflation, plunging economic activity, and unprecedented debt levels, and thus the only way one can postulate any other outcome than a second real estate crash is if the Fed commits to QE to infinity. And I'm talking about overtly commits to it, not the covert kind that they've been doing lately, like having Belgium buy $200 billion of treasury bonds. With a $4.5 trillion and growing balance sheet of toxic high duration bonds, what other choice does the Fed have? And for the coup de grace in this ugly game, here's a quote made this week from the CEO of BlackRock, Lawrence Fink. This is the private equity firm that has bought more Fed-funded homes than any entity on the planet. Quote, the U.S. housing market is structurally more unsound today than before the financial crisis in 2008 because it depends more on government-backed mortgage companies like Fannie Mae and Freddie Mac. Enough said. And thus it becomes quite clear that the Fed cannot allow rates to ever rise, per what I wrote in my January article, 3.0%, enough said, of which I was referring to the rate on the benchmark 10-year Treasury bond. Ironically, I followed that up this last week with 2.6%, enough said, as despite all the Fed's recovery hype, rates have been plunging anew, as the market is clearly calling out the Fed by betting not on an exit strategy, but that QE infinity that we have all long predicted will come true. They, of course, lost the battle for 2.6% last week and even 2.5% briefly, which is where they are currently fighting for their lives today. Just as the Bank of Japan is blatantly supporting the Nikkei at 14,000 to prove Abenomics is working, irrespective of the utterly horrific economic data, the Fed is doing everything in its power to prevent last spring's taper talk interest rate increases from disappearing too, as it too would signify a widespread belief that QE has decidedly failed to produce an actual recovery. Quite ironic, isn't it? I could go on for hours regarding this week's ugly economic developments, but instead we'll simply give a brief summary. In Europe, PMI indices unexpectedly declined to very near the 50 level, signifying the Eurozone remains mired in a zero-growth miasma. That is, if you believe in the deflation propaganda spewed as vehemently by the ECB as the Fed. France is still deeply in recession, Italy saw its bad loans increase for the 59th straight month, and Greek stocks have started plunging anew, as clearly markets are growing leery of an economy that continues to decline at free fall pace, no matter whether the ECB will do whatever it takes. Last week, it was reported that the entire Eurozone experienced GDP growth of just 0.2% in the first quarter, after 0.3% in the fourth quarter. And the scariest part of all is that the leading economy, Germany, which came in at a red hot 0.8%, reported a record plunge in its ZEW Investor Expectations Index this week from 43 in March to 33 in April. Thus, the ECB has all but telegraphed it will take decisive new action at its June 5th meeting, which is just 2 weeks away, in what I have deemed all along as Draghi's reckoning day, which may include such draconian actions as negative deposit rates and/or formal QE. If so, it will once and for all validate what we have said all along, that is, that Europe's economy and finances have grown progressively worse with each passing year. QE to infinity will soon take hold there, a la Japan, and sadly, it will have commenced a measly 15 years after creation of the ill-fated currency union. In India, as we predicted last December, Narendra Modi became the new prime minister, as his BJP party handily swept the moronic Congress Party, which is also the name of a big group of baboons, which had run the nation and the rupee into the ground. Modi, while I don't know everything the guy's going to do, is very pro-gold, and consequently it is highly likely and speculated on that the idiotic tariffs and import restrictions instituted last year against not just gold but silver and platinum as well will be repealed, which should unleash an avalanche of pent-up demand. Remember, even with the restrictions, 2013 Indian gold imports were solid, and likely very solid when incorporating the enormous black market smuggling that developed, while Indian silver imports hit a record high in 2013. There really is no way of quantifying just how important the Modi win is. But put it this way, I have long equated India's Congress Party as oppressing the nation's monetary beliefs the way apartheid leaders oppressed the majority of South African citizens. In both cases, they were overthrown. And in the case of India, it will likely have dramatic ramifications for long-term gold and silver demand. Meanwhile, China and Russia finally signed the long-awaited Holy Grail natural gas agreement, estimated at $400 billion over 30 years. It was signed in person by President Putin of Russia and new Chinese President Xi Jinping. This agreement, which may or may not exclude the dollar entirely, we don't have the pricing details, is a major geopolitical event as it further solidifies the strength of the growing anti-West Asian trading bloc. No doubt, America's aggressive, suicidal military and diplomatic maneuvers in recent years, from places far-reaching as Iraq, Iran, Syria, Libya, and the Ukraine, sealed the deal, which potentially could be a major blow against the soon-to-be-dying petrodollar. The global trade and currency wars are only beginning, and now that America's largest creditor has joined forces with, in the words of Mitt Romney, our greatest geopolitical foe, the odds of the dollar maintaining its reserve currency status for a significant period of time have been greatly diminished. Last week, my articles focused on Fed failure in the aforementioned 2.6% enough said, and the most damning proof yet of QE failure. This week it has been more about comforting readers than anything else amidst the crazy manipulation. First, eviscerating moronic Fed official statements in relaxed gold and silver holders, this is what you're up against, and subsequently pointing out the global parabolic explosion in debt in Why Precious Metals Can't Lose in Simple Pictures. Finally, in the most asinine report ever written, published this morning, or actually it'll be published in a few hours, I dissected the latest FOMC minutes that were published yesterday, pointing out how the Fed is as utterly clueless as it is ineffective, and hence the title of today's audio blog. Well, that's enough for today. Hopefully, you're starting to realize the reality of the world is far different than what the money printing, market manipulation, and propaganda scheme is trying to tell you. Chinks in the armor are showing everywhere, and it's only a matter of time that, like all their fiat Ponzi schemes before it, this one too collapses. This is why you need to consider protecting your net worth now while there's still a chance. And if you do, we hope you'll call Miles Franklin at 800-822-8080 and give us a chance to earn your business. And as always, you can contact me with questions at ahoffman@milesfranklin.com. Thanks.